Hello there, Chevron employees, and welcome. Thank you so much for watching with us today. I'm Sam, and I moderate these weekly presentations. And in just a second, we're going to be joined by Wesley Boudreau, one of our financial advisors. Wesley is going to be covering some steps that you should be taking ahead of the recent transition news from Chevron. Afterward, if he has time, he'll also answer a couple questions, so I invite you to stick around if you're interested in listening for those. I apologize in advance. We don't always have time to answer each and every question, but please feel free to ask away. It's completely anonymous, and I will make sure another Chevron-focused advisor can answer that question for you after the presentation, either through phone or email. While you're watching, you're going to see some links popping up on the screen. Feel free to click on those. They're going to guide you to our calendar where you can schedule a time that works for you to speak with a Chevron-focused advisor, to speak to them about your specific concerns or situation, as well as links to follow us on our LinkedIn and our YouTube. So please take advantage of those resources. We post tons of very useful content for Chevron employees weekly. So please follow us there. And as a quick reminder, we are not affiliated nor endorsed whatsoever by Chevron. We are a completely independent group of financial advisors here. So please keep that in mind as you're listening along as well. And without further ado, let's jump right into it with Wesley Boudreau.
All right, thank you very much for the introduction, Samantha. And like she said, we are going to be talking about the Chevron transition of their headquarters from San Ramon over to Houston. And that process is not going to be overnight. It's going to take a course over the next 5 years or so. We'll dig into kind of what that potentially means for you. We'll talk about some of the different situations we see and things to avoid during a layoff, if that's something that should happen to you in the coming years. And we'll also talk a little bit about the Chevron pension plan, 401k plan, accessibility to those should you need that in the case of a potential layoff. Now, as far as the landscape, if we kind of take a look at overall across America, this isn't something that's new. Unfortunately, we've been seeing layoffs heightened up over the last couple of years. And over the last year or so, this is a little bit dated, September to September, we've seen about 39 million job losses. And if you look at that chart there, you'll see it spiked, hopefully, up in July. It's come down since then. And again, this is not meaning that Chevron is turning around and laying everybody off. It just means that over that transition period, we may obviously see some redundancies or see some layoffs as they're trying to transition people from California over to Houston. As far as other companies, we've been working extensively with a lot of companies over the last 30 years, and some of the ones that we do a lot of work with have unfortunately been affected by this as well. We take a look at AT&T's had about 74,000 layoffs over the last year or so. Kaiser Permanente 2,000, ExxonMobil 15,000, Chevron we're looking at about 4,000, and ConocoPhillips 500 plus or so. But across America, that's represented about 24% of the American population or workforce has experienced some type of layoff in the past 12 months or so. And it's expected that it could be up to 73 million people affected in the coming years through 2030, thanks in part to a lot of the AI development as well. So again, even outside of the potential transition from San Ramon to Houston, it's also something to be aware of some of the AI potentially taking some of those functions or minimizing the need for multiple people in some different roles. As far as the actual transition, again, more time as time comes on, we'll get more information on this. But essentially, what's happening is thanks in part to a lot of different reasons, but primarily, obviously, cost and getting everybody into one place. Chevron's essentially merging the San Ramon with Houston, moving individuals over from San Ramon to Houston. This is not going to affect the Richmond refinery. This is going to be more of your day-to-day function jobs in the headquarters. And some of those may be moving as soon as early next year, and others may take a couple years to transition over there. And as we see this coming through, we'll have more updates and more information case by case and department by department. So always keep in touch with us, and we'll be happy to kind of walk you through that. But it's important to understand all this ahead of time so you can get prepared in case you are tapped on the shoulder and said, hey, you're going in the next 3 months, or you're going in 6 months, or you're going next year, and how to plan and prepare for that, and how to run a cash flow analysis to see where you stand there as well. So that transition, as I mentioned, over the next 5 years, again, not going to happen overnight. And some California-based employees are going to stay over there in San Ramon for a longer period of time, and it may be indefinitely as well, in order to maintain that presence and also help support the other efforts in California as well. But the bulk of jobs over the course of the next 5 years or so will be transitioning. So that's something to be aware of, and that's something that we're talking about here. Now, as far as some of the different things we'll go over in that transition process, should you be tapped on the shoulder to either transition and decide whether you want to quit or whether you're actually getting laid off because there's redundancies in your specific job. There's a lot of different things we go through with our other companies, just so you know what that transition process can look like and what to avoid and what to do. Again, we're not saying that this is happening right now. It's just something to be aware of. So not all of these will necessarily apply to you, but it could be something that applies in the future. So one of the first things is to kind of prepare for financial decisions, kind of take a look at where you are right now. And for lack of a better term, I would say play it out and say that hypothetically, hey, worst case scenario is I'm tapped on the shoulder in 3 months and I got to make a decision of either moving to Houston or quitting, or even I don't have a choice. Maybe they're cutting me. What does it look like? So the best thing to do is kind of run a cash flow analysis or a financial plan now to see what that worst case scenario looks like, and then we can back into other options to show you those other choices, whether it was 2 years down the road or 5 years down the road, or maybe I was proactive and said, hey, look, the writing's on the wall. There's no way I'm moving to Houston. My family's here. I want to go and see what I can do now. So let's figure out what type of other job options I have outside of Chevron, so I can proactively make that change prior to them telling me that something's going to happen. So some of the different things to be aware of, we'll talk a little bit more about Rule of 55, which is an ability to access your 401k at age 55 without the 10% penalty. 72T is an option where if you roll over to an IRA and you want to take distributions to avoid that 10% penalty, you can do so if you set up what's called a substantial and equal periodic payment. And that's the 72T is the tax code for that. It means you have to take withdrawals for at least 5 years or until 59 and a half, whichever is longer. You also want to make sure that you can build up an emergency account if you don't have one set up already, and look for other resources just in case. So that way, to help you with that transition, or if you do get let go, help you with that specific transition as well. Try and look on reducing expenses. Take a look at it as maybe an early, pretend to retire early. This will give you an option to kind of get your spending in check and kind of see, okay, if I were to retire earlier, how would it look? Am I on path to meet those retirement goals? Most of the time we want to reduce spending, but unfortunately I know I've seen a lot of people increase spending in retirement. We're here to police you and kind of give you some ideas, but at the end of the day, it's your money. You can do what you want with it. But if you're able to kind of ahead of time get your budget in order, that's going to be a great thing, because what it allows you to do is reduce your potential spending, and it could help you save more and kind of increase your retirement savings, which in turn could give you that ability to make a decision sooner rather than later, maybe retire early, or maybe stay back and not transition with the company if you want to. Another option would be potentially if you want to make sure you've got something set aside and you don't have an emergency fund set up now while you're still working, you can do a line of credit potentially on your house or your property with obviously property values higher. But that could be an option. But again, there's obviously interest rate factors associated with that. But just keep that in mind. Obviously, it's going to be easier to do a line of credit now while you're still working versus during that transition or if you're laid off. And if you can, again, save and increase your cash reserves in any manner, that's going to be the best case scenario for you. So you've got some flexibility there in that potential transition or layoff period. So if you are actually laid off, do not discuss it with anybody immediately. Give yourself some time before you actually settle in, get your emotions in check. You want to research company policies and severance package options you may be seeing available, so you know what's available to potentially talk about and maybe negotiate whenever it comes time to talking with management about that specific move and that transition that you may be seeing. Another situation is don't refuse help during that transition period. Obviously, this is different than a mass layoff. We're looking at a transition from one headquarters to another. So there's obviously going to be help in that process. But like I said, it's very likely that a lot of people will transition. A lot of people will decide to leave on their own, and some may get cut. So there's likely going to be help and programs that Chevron provides you. So take advantage of those and aim for a favorable reference from your management and act professional. So that way you've got those references as you look for different jobs ahead of time. Another option to explore your options is just look at all the different choices you may be looking at. It could be that we run a cash flow analysis for you, and we run that financial plan and say, well, look, you can go with them if you want, or you don't have to. You can actually retire now. You've done a great job and you've saved enough, and you can do that. That might be the best case scenario. It may be that you've just kept your head down and worked and haven't looked at it, and a lot of times you'd be surprised. So give us a call. We can run through that and show you where you stand one way or the other. You want to just, if you can retire, you can pursue a passion, help with charities, things like that. Maybe work for a charity that gives you compensation. So it kind of is the best of both worlds. You also can, look at maybe going and doing part-time work, and maybe look for a job somewhere else, or maybe even decide to kind of work for yourself. I know chances are you might see some consulting positions potentially in need as that transition happens. Or again, with a lot of these companies that have left California, that's again dried up a lot of the employment. So in some cases, there may be some consulting options or self-employment options you can do, and staying behind and doing that for a year or two, or even and stretch it into retirement and work part-time. So again, just keep, essentially, I guess the best way to do it is just think of all your options and let us know. We can run a cash flow analysis and kind of run those all side by side. But also we need to understand the potential ins and outs of unemployment benefits. So again, that's a situation where, if you decide to leave versus if you're cut in a layoff, there's differences there. We can go through those with you, and you can check on those with California as well. I mentioned before, but utilize references, utilize recommendations for future jobs if you can. Strengthen your professional relationships with everybody there so you can get increased references. Also, it may be that you might have a friend or a buddy or somebody on LinkedIn that's gone and found a different job, and maybe there's some more openings at that specific company, so they can bring you on board. So again, keep your cast your net wide, and talk to as many people as you can in this potential change. Do not miss the opportunity to ask why. This may not be, applicable 100% to this Chevron transition, because I think we know why. But again, if it's something where instead of the transition of moving headquarters, and it's something where you're actually tapped on the shoulder as a layoff because they're reducing or eliminating your job, that's where you want to ask why, and ask if there's anything you can do to help in that transition. Review your employment contracts, see if there's any union contracts there and anti-discrimination statutes that you can review as well, so that you know all the different choices and options you have leading into this potential change. Don't quit without investigating other company options. I think that's going to be understood. If they are making redundancies, then they're going to let you know and open up the job search for other options. Historically, we've seen, I don't want to give an actual percentage, but it's low. Maybe 25% of people or less are able to actually find another job, but you still want to make sure that you're actively looking at that. That can also back into helping with the unemployment situation as well, showing that we're actively looking within the company. Show your openness to other roles in the organization, and it could be, it's tough to the ego, but it could be something where even taking a simpler job and making less money may be enough for you in order to get through the next couple of years prior to retirement. So again, all these can be reviewed one-on-one in the cash flow analysis we talked about. Don't announce your layoff immediately. Go ahead and take some time, reflect on your message before you go posting something on LinkedIn or other social media boards, complaining about it. Again, all that's going to be set in stone, and it's available for other companies to find. So consider how you're perceived by colleagues and others around you, other contacts you may have there as well. And as far as factors to consider, be mindful and cautious to not let your emotions control you. Again, this is not something you have control over. It's not something that's going to be a situation where you're a poor performer. It's just a nature of the business and consolidation efforts of the company. Be careful choosing your words and only sharing with trusted parties. So again, like we said before, don't just go blast it and be emotional about things. Take some time. Take at least 24 hours to reflect before you get your message out there as well, because it is kind of a cat and mouse game. You want to take some time to reflect, make sure you don't make any mistakes, but you also want to get out there ahead of everybody else and get your message out if you're trying to look for another job. And that's why we talked about being proactive and maybe finding something prior. Hopefully Chevron will give notices with ample time to look for other options if that needs to be the case. So let's get into the actual Chevron benefits that you're going to have. We're not going to go through the medical benefits and life insurance. We'll talk about the financial benefits of the pension plan and the 401k plan. We'll talk about how interest rates are affecting your lump sum if you are leaving and decide to take the lump sum as well. So the pension plan, first and foremost, is going to be a classic defined benefit plan. Whether you were starting at Chevron or one of the other legacy Texaco Gulf, something like that companies, they all have formulas based in order to generate your single life annuity. So it's going to look at a multiplier times your years of service times your final average pay to figure out what your single life annuity is going to be for the rest of your life. So let's say maybe you run the numbers, you get a $3,000 a month annuity for the rest of your life. Then from there you have other choices. You can add a period certain, so it's guaranteed for 10, 15, 20 years. That's going to drop that amount a little bit because it puts Chevron on the hook a little bit longer. If you're married or have a domestic partner, you can look at a joint and survivor annuity, so you have a continuation for that person if you pass earlier. Again, that's going to drop that $3,000 example I gave because they're paying out over 2 lives. The uniform income is something unique to Chevron. We don't see this with a lot of other companies, but that's an ability to factor in Social Security, have the same amount before and after Social Security, so your pension actually drops after Social Security kicks in. And then what we saw, leading up, I guess the last decade or so, especially through the pandemic, we saw most people taking the lump sum because interest rates were so low. That was more favorable. But post-pandemic, we saw that rise in interest rates, and we're finally seeing them start dropping. We'll show you on the next slide what that's looking like right now. But there's become an equilibrium where in some cases the annuity makes more sense for you, and in some cases the lump sum is going to make more sense for you as well. But again, that lump sum is essentially Chevron going out there and saying, okay, this person's XYZ years old. The life expectancy is going to be, however many years it's going to be. And we will look at interest rates, do a net present value calculation to give you a lump sum for you to go out there and essentially recreate your same annuity stream over the rest of your life. So that's where those numbers come to play. But before we get into that, let's talk about how much am I going to get if I were to leave or get let go of my pension. The key number to kind of keep in mind is age 60. That's where you get 100% of that pension. If you go earlier, there's a banding based upon your age and years of service, but for the most part, if you get into your 50s, you're going to be up in that far right-hand column. But so what happens if you go before 60, there's a 5% per year reduction. It's not a flat 5%. It's going to be prorated. So if let's say you go at 59.5, that's going to be 2.5%. But you see highlighted, let's say somebody were to leave or get cut at age 55, then they're only getting 75% of that pension. However, if they want to, they do have the ability to defer that out and get those bumps in age bands if they want as well. Talking about the lump sum, okay, so we've mentioned before interest rates are used. We've got a bunch of numbers here on the screen, and I'll zoom in just a moment, but what we're looking at is the interest rates that they use. And Chevron's unique where a lot of companies will update these once a year or once a quarter. Chevron does it every month, so you've got a rolling average on there. They look at the previous third, fourth, and fifth month in order to get that average. And what they do is they use the PPA segment rates, which is what most companies use. Those are the first, second, and third segment. So what they look at is the first segment is the first 5 years retirement. Second segment is for years 6 through 20. And the third segment is going to be years 21 and beyond. So for most of us, that second segment is going to have the highest weighting because it covers 15 years of retirement. So we got the October numbers out. Let's kind of zoom in here so you have a better idea of what this looks like. But what you'll see is that since we have August, September, October, that's going to give us the average for January. So January 2025, we're at 4.36, 4.92, and 5.37. If we look here in December, we're a bit higher at 4.53, 4.99, and 5.41. If we look at that second column and go all the way down the bottom, we were back in July, so about 6-7 months ago, we were at about 5.3% versus that 4.92 we're seeing now come in January. So that's about a 40 basis point change or so. And what that means is, depending upon your age, you could see anywhere from maybe a 3.5 to maybe a 5.5% change in your lump sum over the last from the summer to now. So that might be a great surprise for some of you. Let's say you got a $500,000 lump sum, it might be up by 20 grand or so. $1 million lump sum might be up by 40 or 50 grand. And hopefully those trends continue. The interest rates, if you do see though, September was lower, October kicked up a little bit, so we may kind of plateau here for a little bit, but it's we'll keep an eye on these for you and let you see. But again, when you run the cash flow analysis, we look at all this together for you. Now, as far as the 401k, we're not going to go into the investment options and things like that, but God forbid something does happen and you are let go, you need to tap into it. I mentioned before about the 72T and age 55 rules. So let's kind of dig into the age 55 rule a little bit more in hopes that if you are let go, you've made it to age 55 at least. Because if you're not, let me back up. So typically speaking, for most of your contributions are going to be pre-tax. Some of you may be putting Roth contributions in or after-tax contributions, but the pre-tax in the company match is going to be taxed and a 10% penalty if you access it before age 59.5. However, with 401ks, there's a rule where if you leave the company the year you turn 55 or later, so it doesn't mean you have to be 55, you could leave in January and turn 55 that December, you're able to tap into your 401k and your 401k only without the 10% penalty. So again, be very careful. If you're cut, don't turn around and roll this over to an IRA immediately. You're going to want to at least keep something in that 401k so you have access to it without that 10% penalty. Otherwise, if you roll it to an IRA, you're going to have to set up a 72T and have those parameters and restraints if you want to access it penalty-free. So again, it applies to your current 401k. And I can take a step further. We're not going to suggest this, but we've had individuals where they've unfortunately got let go from a company at 53 or 54, and were able to go and find a job at another firm, work there for about a year, and call it quits at 55, so they can qualify for this. So there are different options to look at if you're going through this specific situation. But like I said, the best way to look at all this is tying it together in that cash flow analysis or a financial plan we can put together for you. If you can give us a call, give us about 10 to 15 minutes. We'll gather some data from you. Then give us a couple of days to put that full report together and get it back over to you so we can sit down and review it, and let you know, okay, if I were cut now, can I retire now? Or if I were to go over to Houston for 3 years, can I do that? Or could I leave Chevron and go find a different job? Can I focus on a job that is maybe quality over quantity? Like, what's the amount of money I need to make for the next couple of years before I retire? So we can go through all those different options for you, and also show you how that pension looks, the annuity versus the lump sum side by side as well, and show you how everything plays out over the next 30, 40 years, and not just how it looks now. So a quick refresher. The retirement group, myself and a lot of the other advisors here at the retirement group focus on just a select few companies. We've worked extensively with Chevron for the last 10 plus years. The retirement group's been around for 30 plus years, but we do have a focus on Chevron. So if you got any questions about the 401k, the pension, healthcare, retiree, medical benefits, life insurance continuation, anything like that, let us know. We'll be happy to help you out. We do have offices around the country, so rest assured we can likely sit down with you face to face. But obviously, this day and age, if you want to have phone calls, email, web meetings, whatever your preferred method is, just let us know. And then obviously take us up on that cash flow analysis I mentioned. I know we've done it with a lot of individuals. We've worked, myself and others have worked extensively with individuals both in San Ramon and Houston. So it may be that we haven't done an update in the last 2 or 3 years, or even the last year, given the change in interest rates, change in the markets, change in maybe inflationary and spending. It's worth revisiting that and running that update if you haven't done one recently. And if you have never done one, then definitely give us a call to get that run for you. So with this, I saw 2 questions come through at this point, and I'll knock those out. But before, I'll leave this screen up while we go through that. But if you want to call us, you can reach that 800-900-5867. You could also email us at info@theretirementgroup.com. And there's 2 QR codes up here. One's to get into our LinkedIn. You can get into our general LinkedIn, or you can actually get specific stuff on Chevron, as we have new webinars and seminars coming up on the matter. You also can get into my calendar or the other Chevron focused calendars if you want to schedule some time to run that cash flow analysis, or just go through some questions or review what your options are. And we can also talk about the management of the 401k as you prepare for retirement as well. Help you there also. So one of the questions that we saw come through was, I kind of touched on this before, but if I have a job lined up already, do I have to take my pension when I leave? So I mentioned this before, that when I was showing you the kind of age banding, and I said that that person maybe retired at 55, only get 75% of their pension. They can actually defer that if they want to. So to answer that question is, no, you do not have to commence your benefits as soon as you retire. They're separate. Obviously, you can't commence benefits until you retire. So number one is you retire, or you get let go, unfortunately. And then you can commit your benefits as early as that next month, or you can defer it. You wouldn't want to defer past 60 because there's no really additional benefit there. That's where you hit 100%. So let's say somebody who's 55, everything else held equal, if they just let that stay at Chevron and waited the other 5 years to collect that, then it's going to grow 5% each year. So if that person, the example of this question, is working somewhere else and they said, hey, I want to take the annuity, then it's not going to make too much sense to get an annuity on top of your income, because that's going to bump you in a higher tax bracket likely, and you're getting a lower annuity rate. So if they can hold off for 3 or 4 or 5 years, then they would want to potentially defer that. On the flip side, if you're thinking, hey, I'm going to take the lump sum, then we need to do a cost analysis, because even though you may only get 75% of the pension, if we look at potential change in interest rates over the years, or investment opportunities, it may be beneficial to take that now, roll it to an IRA and let that grow and defer, and it could come out better. Or you could even say, hey, I'm thinking about taking the annuity, but if I were to take a lump sum and get that into my own personal deferred annuity, it might pay more than what Chevron would do in the next 5 years or so. So again, something to keep in mind when looking at that. One other question: if I need to, can I take a loan or borrow from my 401k? So yeah, we didn't kind of go into this, but again, this is something that you can do as well, but you're doing it as an employee. So it's something you need to prepare for if you think, hey, you get tapped on the shoulder and says that you're coming up in the next wave of people, let's say the next 3 months or 6 months, that has to move over to Houston, and you and your family discuss to say there's no way we're doing this, and you want to pad the bank account prior to maybe leaving, then you can go in and take a loan if you haven't done one already. Depending upon what you've done already or not, typically the maximum is going to be up to $50,000 or 50% of what your balance is. So if you got at least $100,000, you can get up to $50,000 out of there. And what's going to happen is you're going to have to set that up on a payment schedule where you're getting paid. It's coming out of your paycheck, going back into the account. And then let's fast forward. If you do separate service, then you have that option to continue to make those payments by sending a check in. But if you don't, what will happen is over time it will default. It's not a credit default, doesn't affect your credit history or anything like that, but essentially it says, okay, that loan that you have not paid back is going to turn into a withdrawal. So let's say somebody takes out a $20,000 loan, they get $3,000 paid back, and then they get let go. There's $17,000 left, and they decide, hey, I don't want to pay this back. What's going to happen is it may take a couple months, but eventually that's going to default and count as a $17,000 withdrawal. So let's say if that person is 56, then okay, you're going to pay taxes on that 17,000, no penalty. It just goes into your calculation for your income. But let's say if you were 52, then it's the 17,000 of income tax on that plus an extra 10%, so plus a $1,700 penalty on top of that as well. So again, if you're in this situation, have questions, need to review it, just give us a call and let us know. We'll be happy to go through that with you again. So again, I want to thank everybody for taking some time to join us today. Again, a quick reminder, the retirement group, we worked extensively with Chevron. That does not mean we're employed or endorsed by them. And again, this transition is not overnight. It's going to be happening over time, but it's great to go ahead and reach out to us and get your questions answered and run a cash flow analysis and kind of get prepared for any potential changes that may be affecting you personally. All right, thank you, and we hope you have a great day.